Life isn't one single moment. It's a series of chapters. The joyful ones, the chapters we plan for, the ones we celebrate. And then there are the chapters we never expect. A life-changing turn. When a claim happens, it's never just a payout. It's school fees protected. It's a home kept safe. It's income secured. It's a chapter still moving forward. At Discovery Life, we provide protection for every chapter of your story. When life is flourishing and when it feels uncertain. Because protection isn't about fear. It's about enabling life to keep moving forward. Discovery Life, the future of life insurance, now.
Good day, everyone, and we are really honored to have you all here today. Many familiar faces, and we always have the privilege of your time in talking about the product and marketing the product and, putting the product on show for all its key features and its key characteristics. But something we don't get all year round, and just on this one occasion, a unique opportunity, not to sell the product, but to account for a promise. A promise that we make, that when the life takes an unpredictable turn for your clients, we will be there. And this is what we're here to talk about today. 9.1 billion rand in promises kept through Discovery Life's claims in 2025. And that is what Discovery has covered. This is across nearly 9,300 individuals, across severe illnesses, across 215 unique medical conditions, across all life stages, for claims for children who are just 2 days old, to claims to 93-year-olds. That is the range that we're covering. So across all these life stages. But these are numbers, and you'll see them on the screen, and sometimes we forget that there's a client behind every single one of these numbers. And today reminds us of that story. And we know that behind every single rand paid is a client that you placed with us, trustingly, a family that you protected, and a plan that you put in place that worked. So the session really is for you, the advisors who, every day sit across clients, making the case for a protection product. And we hope that this session really gives you the evidence, the insights, and the confidence to talk as powerfully as you ever have before about a protection space. Getting straight into it, just introducing the panel, which probably needs no introduction. I'll start with Dr. Kutsa, who's new to this format, but not new to Discovery Life, 17 years with us, taking over the reins from Dr. Marita. Our Head of Claims and Service, Sylvia Steyn, and then Gareth Friedlander, our Deputy CEO. So thank you again for being here, and the next hour and a bit, we will stick to time. Thank you for being on time. We know a few people will come in, and most welcome. But over the next hour, we hope to unpack a couple of things. In particular, understanding how the choices that you and your clients make at the point of sale impacts on the future outcomes. And on that, Gareth, I think to go straight into it, the choices, who is choosing us, why are they choosing us, and what does this mean for their risk outcomes in the future?
Thank you, Cash, and good morning to everyone. This Claims Roadshow really has become an absolute highlight on our calendar. We, as Cash mentioned, this is kind of us showcasing our promise to you and your clients, and it really is gratifying to see some of the numbers that we will be presenting later today. Also, thank you for all of your partnership, friendship over very many years. You all would have hopefully seen our results that we released a couple of weeks ago through Adrian, and it was an absolutely stellar year, one of the best years in our history, and it really is thanks to your support. It manifested in significant growth kind of across every single metric within the business, including new business, where we retained a dominant position from a market share perspective, writing almost 2 times the amount of new business as the average of the next 4 biggest in the market. And that's thanks to everyone in this room. We really are grateful for that. And that's kind of across the board, whether you look at it, life cover, disability, severe illness, we retain the number 1 market share position for every single benefit. And then on the right-hand side is an interesting statistic that we are really pushing hard towards, and that is from an engagement perspective. As we sit here today, we've never had a more engaged base. Over the last few years, you can see how there's been this constant kind of shift off blue status towards the higher statuses. So you can see a 14% increase over the last 3 years in our gold and diamond clients, and that is absolutely key and incredibly powerful, as I'll show you over the next couple of slides. We are completely aligned to our clients in terms of what manifests in value for them, manifests in value for us as a business. And we are completely aligned to driving that engagement, and you'll see kind of double down on those efforts every single year. This is kind of the shared value scorecard, and we kind of obsessively track these statistics, and you've all seen these stats, and the numbers change. But for 2025, I think the numbers have never been stronger. Last year, I remember reporting a 57% reduction in mortality. Over 2025, it was 73%. It is a mind-blowing, I think, statistic. I think it's beyond what we could have expected to achieve with the model, kind of when it was launched 25 years ago. Just kind of take a step back and think about that for a second. You know, with all the types of deaths, and you'll see them today, motor vehicle accidents, suicides, genetic-related conditions, there are certain deaths that you just cannot change, or at the very least that are not related to kind of vitality status. So given that rump of deaths that are kind of sitting there difficult to impact, the fact that you can change all-cause mortality by 73% is just absolutely remarkable. I think we keep almost being surprised by the power of this model. So it's really kind of firing on all cylinders. The same in the morbidity space, 47% lower claims in our most engaged clients in the morbidity space. And then importantly, it translates into stickiness of clients, into better persistency. Our clients who are the most engaged in the model are also staying the longest with us. So you're seeing a 53% lower lapse rate in our gold and diamond base. And by the way, that is opposite to the traditional model. Traditionally, in life insurance, you start off with this kind of healthy base that goes through underwriting. And then usually your healthier clients lapse at a higher rate than sick clients. Sick clients don't leave. You know, they'll typically hang on to insurance. So you've got this traditional model that works in exactly the opposite direction, where you've got kind of healthy people leaving over time, sick clients staying, and you get this worsening risk pool. You can see what our model does is flips that exactly on its head. Not only are we getting better mortality and morbidity and better overall lapse rates, but the correlation between them means that you're getting this healthier and healthier risk pool emanating over time, and that is incredibly powerful from a profitability perspective. So the model really firing in 2025, and we're really excited about where it's going.
And on that, Gareth, we see claims being paid at an amount of 9.1 billion, Sylvia, across both group and individual life policies. You know, there's some call-outs on the screen, but I'll allow you to walk through those.
Good day, everybody. So, as Cash said, we paid 9.1 billion rand in claims, and this is across both group life and individual life. These numbers just actually represent quite a significant amount of money that's been paid to family, in fact hundreds of families over time, where they really needed this benefit the most. If you have a look at life cover, we paid 3.1 billion rand in life cover alone, but our claims is not just about life cover. 1.7 billion was paid to severe illness, and capital disability, nearly 1 billion rand was paid to clients. Income continuation benefits, we've paid over 684 million rand in income continuation benefits. And if you move over to the right of the screen, if you have a look at the other payments that we've made for benefits like health plan protector, global education, funeral benefit, and overhead expenses, quite significant. And I'm going to hand over to Gareth to take us through the dollar life claim statistics as well.
Yeah, sure, Sylvia. So this is kind of snuck into this presentation now over the years, where we also report on Discovery Life International as a business. Through our Dollar Life Plan, it's become an unbelievably important component of financial planning, and the Dollar Plan has now paid, $36 million offshore to clients through claims, and we're seeing those numbers obviously increase exponentially as the take-up of that plan increases, and I'll talk about some of the opportunities later today. But a really powerful performance from Discovery Life International through our Dollar Plan.
And this is the almost yin and yang of our story, that you have the risk protection element, and then it works almost hand in hand with the shared value component, as you've described, Gareth. In the 25 years of us paying claims, it is a milestone, a quarter of a century in paying claims. There's a journey that we've watched, and we've seen claims ramp up exponentially, as you would expect. But then there's the other element, the shared value element, and watching these play out hand in hand has been quite fascinating. Dr. Kutzer, just seeing the claims that we've paid over time, what stands out for you in terms of claim numbers, and then again, importantly, what is, we say we've got a record of 99% of our claims paid, and the question on everyone's mind is, what is that 0.7% that we don't pay?
Yes, so are you absolutely correct, Cash? We've paid more than 99%, 99.6% actually, of all valid claims that were submitted to Discovery Life in 2025. There were a small number of claims that were repudiated, basically for fraud, non-disclosure and misrepresentation. But we are in the business of paying claims. That is what we want to do. We want to protect the lives of our clients. So we are proud that we can stand here and say that we have paid more than 99% of valid claims. When we look at the numbers, we have paid 9,289 claims during 2025. And then just another staggering number, we have more than 2.2 trillion rand of cover in force at this point. So I think this is really a remarkable achievement.
Yeah.
If we look at our story through the past 25 years, we can see that it took a while for us to get to a point where we were starting paying claims as our booked age. And Sylvia, maybe you can tell us how that story unfolded.
Oh, absolutely. So, in the first 20 years, we paid 31 billion rand. That's an incredible amount of money. But just in the last 5 years alone, that's risen to 36 billion. So, if you have a look at the total stats, we've paid over 67 billion rand to date. That in itself is quite a powerful story in terms of retaining our commitment to paying claims and being there for clients when they need us most. So, yes, I think that's something to be quite proud of.
And as we've been, we started in our introduction talking about the other side of the same coin, Gareth, and that is the shared value component of this. That too has ramped up over the years, and we're seeing some powerful outcomes from the model on the life side.
Absolutely, Cash. I think everyone in this room kind of knows now the power of things like payback and cash conversion and all of the shared value benefits that have really changed the paradigm of insurance, where now each year we're paying out billions of rands to healthy clients. Last year it was 2.4 billion rand through our shared value benefits like paybacks and cash conversions. We've now hit 14.4 billion through paybacks alone. It is a remarkable outcome. It really, really is. Payback is literally the physical manifestation of shared value. If you think about the stats I just showed you, all of those clients who are now demonstrating lower mortality and morbidity, that then creates an asset on our book, and we pass that asset back to the client who's created it by being healthy through the payback benefit. That's kind of the philosophy behind payback, and these numbers are enormous. 13 years to reach our first billion. I remember giving the presentation actually where we had reached that first billion. But you can see that took 13 years. We're now paying over $1 billion a year. So the growth, firstly, of the book, and secondly, in terms of the value proposition inherent in the book, in terms of those payback benefits, and the increased engagement in the base, is all driving these types of outcomes. So really, really powerful. Cash conversion, you can see those numbers kind of skyrocketing now, where we've paid 4.2 billion already under cash conversion. This is very quickly kind of getting to the payback type of numbers, and will overtake it in years to come. So incredibly powerful numbers under cash conversion. We're seeing individual cash conversions, of 20, 30, 40 million rand paid out to clients. So an incredibly powerful benefit that really helps clients, sometimes saves clients in terms of their retirement predicament, and really helps clients in terms of supplementing retirement savings in a very, very unique way. And then obviously a whole host of other benefits, cash, like university funder, 3.2 billion rand that will pay in terms of covering children's education because their parents are healthy. It's remarkable. These are completely changing the paradigm of insurance. Healthy parents are funding 3.2 billion rand in their kids' university fees. Quite a remarkable outcome. And obviously then along the bottom, things like dollar payback fund, the business payback fund as well. So across the various niches of the product suite, all the shared value benefits kind of playing out very, very strongly.
And we often watch statements of other insurers considering the billions that they keep in reserve to pay claims. And on our front, we're proudly able to stand up here talking about the billions that we keep in reserve to pay for from a shared value perspective. And I think that's a marvelous outcome of our model. And I guess that leads us to that next story in this evolution of our shared value model, like how we're getting to the next sort of tier of paying out shared value. And that comes in the form of almost real-time rewards and real-time engagement and rewarding incentives in the very near future. But from a personalization of engagement, the next best actions that are indicated for our clients often lead to phenomenal outcomes on the life side as well. Gareth and Dr. D, actually the entire panel was fascinated by the slides, so I'm sure there'll be lots of comments across the board. But Dr. D, let's start with you. From an engagement perspective, what do these actions mean in terms of outcomes for our clients?
This is really something that we are extremely proud of. So we have now personalized recommendations for screenings for our clients. It's AI-based, so we take their current health situation and their engagement into consideration, and then we continually give them new recommendations for screening tests that they need to do. So we see that if we take, for example, our engaged clients, they were 40% more likely to complete screening in 2025 if we compare that to the year before. So really a powerful tool. So in 2025, 14,775 clients completed about 18,000 screening tests that were recommended to them. We saw about 9,500 cancer screenings. We saw about 5,500 rand health checks and some metabolic health checks, and roughly 700 organ-specific screenings. So the 18,000 screening tests that were recommended translated into 47 SIP claims that we paid. Of those 47 SIP claims, 35 were for cancer. Now, the really powerful story comes in if you understand that 32 of those claims that were paid for cancer was for stage 1 and stage 2 cancer, which is absolutely remarkable. This means that the cancer were detected first when it was still small. We could intervene quickly, and their outcome is going to be much better. We also saw about 12 heart and artery benefit conditions that led into claims, and again, with early intervention, the outcome will be much better for these clients. So this is an extremely powerful next step in our how we want to get people healthier in their products that they use.
And the rewards alongside that, Gareth. I mean, we know, I see it with my kid. There's nothing that gets done without incentivizing it. But the same goes for all of us. The enhanced rewards that we actually see through encouraging and nudging, clients are deriving incredible value out of that as well.
Yeah, Kash, this is super exciting. I think the whole concept, if you kind of stand back and think what's being done here, you've got an AI algorithm, synthesizing millions of lines of data around our clients, calculating based on each individual client's risk factors and health information and propensity models, what is the very next best action that that client should do for their health. We then throw money at them to go do it, and then, in this case, 32 clients through that actually picked up an early stage cancer because our model picked them out of a haystack and said, go and get this checked. And that's a life saved.
Yeah.
That's genuinely a life saved.
Life saving as well. 32 were early stage, but 3 were later. I mean, if
Absolutely.
you think of it that way,
Yeah.
there
No,
were 3.
it really is unbelievably powerful. I think everyone's talking about AI and what's the impact it's going to have on the world and on various industries. And I think a lot of companies talk about operational efficiencies, and we're obviously using it for that as well. But this is so different. This is using AI to genuinely save lives, to genuinely impact the risk and health of our clients. And that's unbelievably exciting. And I think it also simplifies the model. It tells clients, this is what you need to do. Instead of a whole list of actions, those are still available through the Vitality program. But it's really going to tell clients, this is the next best thing that you should do. And, that could end up saving that client's life. And it's obviously having a massive impact on our book. And then you talked about the reward side. We've obviously got the personalized payback benefit, where each month that you close that health ring, we just deposit your maximum payback into your fund. I mean, I had it. I didn't even realize it was happening. I went for a dental checkup in January. And as I came out of there, I got into WhatsApp saying, congrats, here's 3,000 Rand in your payback fund. And it is a remarkable experience. It's the first time that we can do paybacks in real time. Up until now, it's been kind of an anniversary process. But now, as clients go for these actions, close these rings, they get a real-time deposit of rands into their fund. And I think that has such a powerful impact.
And I keep thinking of it of course, I work closest with everyone in the room, and I keep thinking of it from your perspective and understanding that I can literally give a life insurance product that lives and breathes every day to my client, as opposed to a product they're parking away in some cabinet in a corner. And I think that shows as well in terms of our record of what we're paying to clients who are surviving certain illnesses and disabilities, but then also the shared value component over and above that, which is the pink bar on the screen, which no competitor can really rival at this point. But if you look at the stats, Gareth, I mean, this goes to show. This is exactly what our model's intended to do. This is exactly what we set out to do, not to, reverse the possibility of paying a claim or erode the possibility of paying a claim, but to ensure that a life insurance product is living and breathing with every single client experiencing that product.
Yeah, I mean, just to explain these graphs, the blue line, the blue part of the bar, dark blue, is effectively the life cover claim that each company has paid, or the sum of the life cover claims. And then the light blue are the living benefit claims that those companies pay. So things like severe illness, disability, income protection. So you can see across the industry, the vast majority of their claims actually tend to be life cover. So there's an extra kind of 31% that they'll pay to living clients through those living benefits. We're completely the opposite. We pay an enormous amount of life cover claims, obviously, but we're paying more living benefit claims. That talks to a couple of things. Yourselves, in terms of how you've been able to, generate those additional benefit take-up across your base, and obviously the model also rewards clients through the more benefits you take, the deeper the integration, the deeper the shared value benefits. So there's a kind of intrinsic link between the value that clients get and that incentivizes them to take more cover. And then obviously the pink bar is what we've actually paid to healthy clients through the shared value benefits. So you can see we're paying almost 3 times the death value as kind of an overall payment amount. It's completely different from what everyone else in the market is doing. I think we're really proud of that.
And then to bring it back to the real purpose of what a life insurance, a risk protection product does, I guess the base of it all is life cover. And the intention is to create some form of a legacy. Sylvia, we see life cover and deaths across various ages, across various conditions, and for various reasons. There are always fascinating statistics that come out of this, and I love hearing you talk about it. So take us through a couple.
Absolutely. Thanks, Cash. So, you can see from this chart how causes of claims actually shift with age. Given our stats for last year, once again, heart and artery and cancer, those first two blue blocks, dominate across all ages. And that's closely followed by nervous system conditions, which are typically strokes, severe strokes, and respiratory conditions. And then moving to the end, where you've got that purple block, those are your motor vehicle accidents. And there we're actually seeing accidents happen mostly in younger claimants, younger clients. And overall, if you just have a look at what we're doing here, there's a snapshot of claims that we've paid, death claims that we've paid. The longest duration of one case was 25 years. So that client has walked that sort of journey with us for 25 years. Unfortunately, he passed away from a heart attack in November last year. And the shortest duration of the policy, a mere 29 days. This was a young client in her early 40s, healthy. And she had picked her kids up from school and was driving along and ended up just suddenly having chest pain, shortness of breath, and she literally passed away straight away. Very sad. It's such that's a young age, three relatively young kids. And then, if you look at the older claimants, these conditions with old clients, not surprising, heart and artery conditions and strokes, passing away from that. And then, sadly, you've got young adults who also pass away, which just shows you how unpredictable life can be. And, we have the youngest female claimant. And I actually read up on this case study. So it was actually quite interesting, where something quite mundane like flu, okay, she started off having flu-like symptoms, ended up having quite severe headaches, and was eventually admitted to hospital. She ended up having bacterial meningitis. And if that's not treated early enough, Dr. Deirdre will tell you, it can be life-threatening. And unfortunately, she passed away as a result of that. That's a young life snapped away. And then the youngest claimant, 23 years old, is unfortunately involved in a shooting incident and died as a result. And sadly, he has a 2-year-old kid that he's left behind. Okay? But the good thing is, some financial advisor had the foresight to give him global education. So this kid has his sort of future secured when it comes to global ed. So overall, if you just have a look at the stats, 16% of our claims were unnatural causes. And that's quite remarkable given all of these conditions, all of the sort of claims for unnatural causes, motor vehicles, crime, suicide, and trauma. But I'm going to hand back to you to take us through that.
Yeah, so as Sylvia said, 16% of deaths are unnatural. And when we break down the unnatural deaths, we often spend a lot of time as a group, as a team on this slide, because it's fascinating, and it's also it makes me a bit more alert, and I actually feel a lot more safer in a car than my male counterpart, because that statistic draws some real attention to. So where a male and a female, where males are involved in a car accident, they're 3 times more likely for it being a fatal accident than a female fatal car accident. I haven't said that very well, but I think Dr. D, you can talk to some of these.
Yeah, so we have paid a number of claims for unnatural deaths in 2025. The sad part of this is these are not people that were sick. They probably left home the morning feeling well, said bye-bye to everybody and just never came back home. And that is the sad part. But this is also why we have life insurance, to protect the family left behind for cases like this. So about 24% of unnatural deaths were still caused by accident, motor vehicle accidents, but we also saw some other transport-related deaths, We had a boat accident, a plane accident, we had a train accident and a bicycle accident, even a paragliding accident.
Okay.
We also unfortunately had to pay a death claim for somebody that was out jogging and then involved in a pedestrian vehicle accident. We had a death claim for somebody that died of hypothermia, and on the other end of the spectrum, somebody that was electrocuted. We had a snake bite and a dog bite. So we paid claims for almost every condition that you could imagine in 2025 for unnatural deaths. Yeah, and we are proud that we can at least say that by these people being insured with us, we could at least alleviate the financial constraints for the family members left behind when the family member passed away.
And like you said, Dr. D, it's over 30 unique conditions under some of these traumatic events.
Yes.
And then what stands out again, Gareth, 1 suicide claim per week. That's trending upwards. So incredibly worrying, the mental health sphere.
Yeah, I think we spent a lot of time last year on the suicide stats and just slightly down, thankfully.
Yes, it is a bit down.
Compared to last year, but still
Still
incredibly
high.
high. One a week. I mean,
Yeah.
that the team is dealing with. It's obviously a really important component for
It
us to
is.
focus on, and I think you can see it in the whole group,
Yes.
focusing on mental health and how we can help our clients with that. But yeah, no, those stats are always incredibly sad to see.
But something our life cover allows for is the power of hindsight and enabling cover for conditions that you might live through. Very different from a terminal benefit. Our access cover feature. Gareth, if you could just talk us through some of the high-level stats around this. I think everyone in the room is familiar, but if you're not, I'm sure Gareth will expand.
Yeah, Cash, this really is powerful. I think advisors tend to sell life cover as if it is just life cover, and I completely get the fact that you've got a half an hour with a client and are probably not going to get to explain every single feature on the policy. But this is one of those where the power just comes out at claim stage, where, yes, you've sold them life cover, but where we're completely unique is that when it comes to a client having had a particular illness, they've got this benefit of hindsight in terms of the financial planning, where the advisor can actually then sit with the client and say, hold on, you might have severe illness or you might not, or do you have enough severe illness? Do we want to convert some of your life cover into cash today? So it really gives you that power of kind of hindsight, that retrospective financial planning capability that is just so powerful, because unfortunately for all the best financial planning in the world, you're plugging in an F&A, but at point of death in 20, 30, 40 years' time, each client's circumstances are going to be different. And this really gives you that flexibility at that point. And some of these stats are quite incredible, Cash. So of our access cover claimants, 68% didn't even have severe illness. I mean, that tells you this was used for a client who effectively accessed a payout today by accessing their life cover when they didn't have severe illness. And of those who did have severe illness, the access cover payout was actually more than double, 207% of the severe illness payout. So it just shows you the power of using that access cover benefit. Those clients clearly had severe illness but insufficient for their needs, and the advisor was able to sit with the client and say, hold on, let's access some of your life cover today. It might have saved their life. It might have allowed them to go and, do whatever they needed to do. And remember, this is not terminal illness. This is kind of far less severe than a terminal illness benefit, which pays out when you're expected to die within the next 12 months. One of our access cover claimants is still alive after claiming more than 12 years ago. Okay, just let that sink in. That client accessed their life cover 12 years ago. It's completely different from anything else that exists in the market today and completely differentiates our life cover benefit.
I think something important as well, Gareth, and we've seen it in a number of cases, is the clients didn't originally qualify for the severe illness benefit. Part of the the advice process is to always explain a lot of the features of the benefits and what you could live through and what you can die from. And we understand that affordability sometimes doesn't permit, or they simply don't qualify for cover. And this is a brilliant feature that grants access to clients who wouldn't have been able to access cover like this. From a severe illness benefit perspective, I think this is always the meat of the presentation because we see so much coming through here. It is the flagship benefit, and the statistics around what people go through. It's always heartfelt. It always feels very personal, and we know that the cover in the industry falls short of what clients actually need. Gareth, you sit on the ASISA board that works through understanding what the gap in our market is from an insurance perspective. What have we seen in terms of the critical illness gap?
Yeah, Cash, so through ASISA, we undertake to kind of perform what we call the insurance gap study, which is a gap study of the insurance shortfall that clients have in South Africa, and it's done every 3 years. So we did it last year in 2025. And for the first time, we actually attempted to look at the severe illness gap. We've never included severe illness, or ASISA has never included severe illness in their gap study for a very good reason. And that's because to assess a gap, you need to know what the need is. And doing an F&A for severe illness is actually a hard thing to do. If I ask you all how you do F&As for severe illness, you'll probably get 10 or 15 different answers in this room. So there's no universally accepted way of exactly how to quantify a severe illness need, and therefore quantifying a gap was difficult. But nevertheless, we wanted to try and understand what is the gap. And so what the gap study looked at is they looked at using the gross annual income as one way of assessing how much a severe illness a client needs. I'd argue that's probably way too low, but nevertheless, they wanted to kind of get a sense and peg that need somewhere. And the outcomes were staggering. As I said, we've never done this before. Firstly, let me make the point that 85% of South African earners don't even have severe illness cover, which is a staggering statistic, and one that we've learned for the first time last year. And then of those who do have severe illness, they're only sitting at about 3 months' worth of income as an average sum assured. So there's a tremendous gap in the context of severe illness. I think our book looks quite different from this. This is the South African, general market, but it shows you how much underinsurance sits out there in the market and how much need is sitting unfulfilled. And obviously that creates opportunities for advisors as well. So hopefully we can go a long way towards filling that gap, when we redo this study in 2028.
As far as industry standards go as well, Gareth, a broad brush approach is having SCEDEP definitions covered for, but then there's everything outside of SCEDEP which we see being highly utilized under our benefit that also requires comprehensive coverage. Sylvia, the causes of severe illness are vast. As I said, there were 215 unique medical conditions, but high level, what were some of the headliners?
So, you can see from here, cancer and heart and artery dominate again. But severe illness claims are not just about heart and artery conditions. There's just so many other conditions, like Cash mentioned, that clients can claim for. And then, that just really brings home the importance of having whole body coverage. And if you have a look at SCEDEP, only 51% of our claims met SCEDEP criteria. So, the rest is that whole body coverage that is so vital. And if you just look at the sort of breakdown by severity, our first sort of severity A, Bs and Cs represent about 44% of our claims paid. Okay, those are typically ones that you would automatically be covered for and sort of know you're going to claim for heart and artery, stroke, cancer, that type of thing. But you look at the more sort of moderate claims, severities, 56%, that's more than half of our claims, are paid at lower severities, ranging from D to G. And that's just, once again, brings home the importance of that whole body coverage. And as we spoke earlier, 1.7 billion paid in claims for severe illness alone.
And Doc, again, cancer has seemed to be the headliner for some years now, and it continues to be both for a top cause for males and females. Where do we see these cancerous events? I mean, it's across the whole body, but you would be able to explain the extent of which we're seeing these across the genders.
So, guys, unfortunately, we did see an increase in cancer diagnosis across the board. But what we are glad about is that the increase in the lower severities far outweighs the increase in the higher severities. And that is really good news. So, prostate cancer remained the number one cancer claim under our males that claimed. 34% of all cancer claims for males were for prostate cancer. The good news here is that 80% of those claims were lower severities, which is very treatable with an excellent prognosis. When we look at our females, 45% of ladies that claimed for cancers had breast cancer. Unfortunately, the stats there for the lower severities are lagging behind a little bit, but there was still an improvement when compared to historical data. So 51% of the breast cancer claims were for the lower severities.
Okay. No, that goes to show or highlights the importance of early detection and the need for
very
it.
Important.
And Gareth, I mean, this is where your mechanisms like your personal health pathways and a shared value model, they play heavily into the space of encouraging better outcomes for clients, just generally. We see a particular experience for Jane through a personal health pathway experience.
Yeah, Cash, I mean, it kind of goes back to what I was talking to earlier, where, you know, you've got clients being nudged to go for these screenings, and it really is having a big impact. As Dr. D said, I mean, you can see the shift in kind of early stage cancer claims going from 45 to 53%. That's actually quite a big shift in the context of a short space of time in something as prevalent and as large as cancer. So that is really encouraging to see that more and more claims are being picked up earlier. And, you know, through personal health pathways, I mean, this was one example. We saw that there were something like 47 last year where clients went through the nudges for their screening, picked up, say, cancer or a heart condition. This client picked up stage 1 breast cancer, you know, very well treatable, great prognosis, but was paid due to having lifetime 100% claim due to having been nudged to go for that screening. So 3.6 million rand paid to this client, you know, kind of facilitated through the personal health pathways journey.
Yes.
And I think part of the risk, I mean, the new cancer trends and modern cancer risks that we're seeing today comes with the survivorship element. So we're screening, we're picking up these events earlier, but then there's the secondary risk that emerges that if you've survived the first event, there is a likelihood that you could have cancer again. And knowing that there's comprehensive cover in place for that entire journey, whether it's early stage pickup or relapse of that cancer, is important. I mean, we see that, Sylvia, through a particular claim that we paid last year, not just the only, but I guess, you know, this one needs to be spotlit.
Oh, absolutely. So, I mean, if you look at this, Matthew's experience, he took out a life plan with the new Lifetime 200, to be honest. And he was unfortunately diagnosed 4 years after having taken out the policy he was diagnosed with colon cancer. Came in at a severity C, so that meant it would have been a stage 2 cancer. Okay, and I think the treatment for that is absolutely brutal. But be that as may, we paid him 100% of his sum assured because he also qualified for 2 additional upgrades. So that was 4.3 million rand. And he went through his treatment, and after a couple of years, unfortunately, after having been in remission, his cancer returned. And because he has the relapse benefit, we were able to pay another 100% of his benefit. So he's effectively received 200% of his sum assured. I mean, and that is just something that stands out for us in the market.
And I mean, there's some features that we've spoken about, we've sort of briefed over, and like I said up front, this wasn't about selling the product at all. It's more about giving the evidence behind why the product is required. But just for anyone in the room wondering what the lifetime feature is, this is our flagship feature of our benefit. It allows us to almost do part of that F&A that you said was so tricky, Gareth. You sort of plan for the inevitability of varying conditions across varying body systems and at varying levels of severity. And I think the lifetime feature, very cleverly structured, provides a comparable boost to the comparable financial impact that that condition would have. Medically designed together with the actuaries, I think it's an incredibly smart feature. And then the cancer relapse benefit playing out very similarly to that, but I guess being called out just because of the relevance of that type of benefit today.
Yeah, Cash, I mean, lifetime really has become flagship, and the take-up is very, very high. I've had advisors actually ask me the question, should I take lifetime or should I just take more severe illness? You could, I guess, buy up your severe illness sum assured by 20-30% instead of adding lifetime. And I think for me, the unequivocal answer is lifetime is designed to create a scientific outcome for your clients. Remember what I said about severe illness F&As? At the best of times, you're kind of getting an educated thumbsuck onto what amount your client needs. So at least around that figure, have some science that flexes the amount that the client should get based on actual criteria, things like assistive care, longevity of the illness, devices that clients may need, etc. And that was really the thinking behind the lifetime benefit, to provide that science and flex the claim amount accordingly. And obviously it comes with that cancer relapse benefit, which is just absolutely powerful.
Mm. Alongside that science is the concept of multiple claims, because we know that these things don't just happen once. It's not a once-off event, Dr. D. We've often spoken about, heart attacks happening. We've got a claims example coming up. If I don't hear or see some jaws dropping, I will seriously question like alarming case studies coming out of this feature, Gareth. Multiple claims remains the most, I think, the most powerful feature of any product in the market.
No, Cash, and this is another one of those where advisors are not going to explain the ins and outs of multiple claims in a session with a client, and probably every company is going out there saying we pay multiple claims, and they do. But it's the devil in the detail of how you pay multiple claims and where you don't pay multiple claims. And we have unequivocally the strongest multiple claims definition in the market, and we pay where it actually matters. And multiple claims are just becoming more and more important when you look at the data. All these trends we've talked about today, people are living longer, we all know about that. We're living longer actually because medicine, like Dr. D does, is good at keeping us alive. The treatment has got better, and people are living longer because of medical advancements. Actually, we're not healthier. Yes, our gold and diamond clients are healthier, but at a global scale, if you look at disease burden indices, they're actually all increasing. Obesity is increasing, diabetes is increasing, cancer is increasing, heart and artery conditions are increasing. So we're actually sicker, and yet we're living longer. Those two trends, they sound like they're in contradiction to each other, and in some ways they are, but medicine has become really good at keeping people alive, but it actually talks directly to multiple claims. In the past, the first heart attack killed you. If it didn't, the second one did. Now we're seeing clients live through multiple heart events. We'll talk to that case study. Jump to it now.
Just to bring it up while we're in the depths of that conversation. Sylvia, I mean, this is we've had the case where we highlighted the client of 14 claims. This is completely different. It's not the 14 claimant coming through for his 21st. This is a different client. And I'd love if you could take the audience through this one.
Great, thank you. So, I mean, Cash, I actually couldn't believe this case when I saw it. But effectively, this client took out his policy in 2002, way back when.
Sylvia,
managed-
sorry, I'm
yeah.
interrupting, but I just want everyone to notice that this was a comprehensive plus severe illness benefit, and it's played
thank
out
you,
this
yeah.
way. It's not even a lifetime feature. This is probably, in our world, the most vanilla benefit that a client can have.
Yeah, he had
So
minimum
the-
protective fund as well. So, yeah. Took out his policy in 2002, and a couple of years later, his first claim came in for macular degeneration, and unfortunately, that led to some vision loss quite quickly. So we paid 2 claims for that, a severity F, and then later on the severity B for vision loss. And a few years later, lo and behold, his cardiac problems started. He had quite a bad heart attack and ended up having to have a bypass graft and qualified for 50% payout. And then from there, the very next year or 2, he ended up having 4 angioplasties and stents. And each of them led to a 10% payout. And it just goes on and on. 2020, he had more stents, 21, 22, 23, 24, and 25. We've just finished paying the last claim now. And it did get to a point, I'll be honest, where we thought this is impossible. And we actually contacted the cardiologist rooms. And it turns out that this client has a long-standing complex history, obviously, of artery disease, coronary artery disease. And he has this condition that his arteries just keep on narrowing. So he is unfortunately one of those clients who just keeps on getting these stents. And we all know that if your artery is narrow, you are at a high risk of having a heart attack. And so he's really being closely monitored continuously. I mean, Dr. Didre, it's probably
I think
something very unusual.
this is definitely an industry record, I'm quite sure. But it might actually even be a medical record. It is definitely not a case that we see every day. But for this client, his policy and the way it was structured really worked out extremely well. And we could pay him for every procedure that he needed for his heart.
Yeah, absolutely.
And it's exactly that. I mean, we're talking about severe illness is heartfelt. I mean, you see it has a personal impact, it has a mental impact, but there's a financial impact. And that's actually why we're here today, Gareth. We see these across all body systems, and we see them at a lower severity sometimes, where a product wouldn't really stand in to bridge that financial gap.
And I think the reason we've put this graph up there is to show the difference between how we treat multiple claims versus how the traditional product would. So it's all very well to say I cover multiple claims if it's not related, if it's in a different body system. But of our heart and artery related multiple claims last year, 61% were related. So that makes sense. When something, we've seen the case study, when something is there's a risk factor, that's where the claims are going to happen.
And we also continue to pay him for lower severity claims after he already
Exactly.
had
So
his-
that's on the right-hand side. What we've done there is broken down of those subsequent related claims, are they higher, lower, or equal severity? And again, the market will typically say, yes, we'll pay, but only if it's a higher severity. Whereas Discovery is paying regardless. And actually, 64% of the time, they're lower or equal severity. So that's 64% of the time that the traditional product wouldn't pay. So you can see when you drill down into the devil of the detail of those multiple claims definitions is exactly where our product performs. It's exactly where the claims start to come. And I think this is, again, it's linked to everything we've been talking about today. Because you're doing continued surveillance once you've had a claim, you're going to be picking things up early, hopefully. That's the point. Once you've had a cancer, once you've had a heart event, you're going to go for constant checkups and pick up something before it progresses. So the subsequent claim will be a lot of the time equal or lower severity, and will pay where traditionally the product, competitors wouldn't.
Yes.
No, this advisor definitely needs a pat on the back. As I said, it's the choices made today for the product that you place your client on.
I think that is the issue, right?
Yeah.
Placing a client on a product that doesn't have this is hugely problematic in the future. It's, once you've had that first claim, good luck getting cover related to heart and artery again. And that's why you need this. You need a product that's been designed to stand the test of time in terms of where medical trends are going. And that's exactly what we're seeing in our book.
We talk about it in the context of a single person and a life assured, but then it's important to think about the family and the unit as a whole, and the children involved and the parents involved and the extended unit that life touches. Gareth, we have these automatic features built into our severe illness benefit that aid in financial protection for when your loved one suffers an illness. And then we have the standalone cover, which I think is incredibly relevant in the environment that we're living in today, considering the types of claims that we see, the cancer claims in children. Maybe walk us through some of the automatic features and the really alarming statistics around numbers and claims paid under these.
No, sure. Cash, feel very strongly about this. I think you are all in the game of protecting people against, these life-changing events. And I really don't think there's anything worse than a child severe illness or child disability in terms of the impact that has on the entire family. And yet, so few people think to insure against this almost worst, kind of worst of life-changing events. And obviously we've got our automatic features, and that's fantastic, but it's limited, right? It's a free feature that's in the severe illness product where we'll pay 10% of the sum assured, and it's got caps. But even in that context, we've paid 11.4 million rand. Under, these are small claim amounts because they're free, embedded in the benefit, but you can see how often it actually happens when you've, and obviously dealing with each one of these is an emotional, difficult situation. 233 claims under those benefits. But it's insufficient. If you have a child who's going through that, I think every parent, every family would want to be able to kind of put everything else aside and focus on what you're going through as a family. And often this is going to be a lifelong journey with that child. So, a couple of 100,000 rand, frankly, is not going to get you very far in terms of dealing with that. And that's why the Child Protector as a buy-up benefit, I think, is an absolute must. It would almost be the first thing that I think advisors should consider adding when their clients have kids. So if there's something coming out of today, please have a look at your books. We can tell you exactly which clients have kids and don't have Child Protector. It's a very easy servicing add-on opportunity. We'll talk to some of that later today. But these stats are staggering. I mean, that 1 in 10, we talked about it last year, 1 in 10 kids will have a life-changing event by the time they're 18. So in your kids' class, 2 or 3 of those children will have had a life-changing event. It is a staggering statistic. It's a massively impactful event on the family, and there is a brilliant insurance offering for it. And we should be encouraging that across all of our clients. It's fairly low premium, it's easy in terms of underwriting, and it's something that you can add to your books. Dr. D, you deal with a lot of these as well. And
I just want to add maybe to that the Child Protector benefit is really tailor-made alongside the problems we see in children. It is not sort of try and fitting the child onto the adult benefit. So this is really particularly fashioned around what we see in children. And that is why it is such an incredibly valuable benefit to add for somebody that has got a family. So I can say that we have paid claims for numerous conditions under these benefits in 2025. The most common one for the children were alongside the nervous system benefit, where we saw claims mainly for global developmental delays, paralysis, and then stroke. I had to go and double check that because I thought stroke, but it is in fact true. It was obviously not because of vascular disease, it was for other reasons, but we paid several claims for strokes under this benefit in young children. The youngest child that we've paid a claim for was only 2 days old. This baby was born with a very unusual but unfortunately very debilitating syndrome, with multiple heart defects and all other kinds of problems. But yeah, 2 days, that's our record for the youngest client that we've paid for in 2025. We've also paid cancer claims under this benefit. That's our second highest category. And unfortunately, leukemia still remains the leading type of cancer that our children suffers from.
Yeah, no, this slide always leaves me with a sense of fear. I don't like it, but I think it just points to the necessity for the benefit. And yeah, I mean, we have auto features in numerous benefits, and one benefit that I guess goes hand in hand with the rest of our flagship suite is our capital disability benefit. And Sylvia and Doc, we've seen disabilities across all ages. It's such a fallacy that, you know, disabilities only happen in your old age, and that's when you lose sight and vision and ability. We actually see it across every age group that we insure.
Across every age group. And then, interestingly enough, even if we look at the highest risks for disability, which would still be cancer, that is also the main claim event for every age group that we insure. The second and third highest risk for capital disability is under our nervous system and musculoskeletal benefit, and that makes up 35% of the capital disability claims we pay. We have about 300,000 lives on our capital disability benefit. And then for some other reason, 70% of those are males.
I know.
So I think we need to go out and sell this to our female clients. They also need capital disability insurance.
No, absolutely. Absolutely. I think you're spot on. Males are 19% more likely to claim for disability. This is once you weight it appropriately. But it still means that women have a significant disability risk, and there should be an equal amount of cover, in my view. So if we consider the construct of the benefit, Gareth, the construct was such that we needed to create something objective to enable better claims processes, more clear claims processes, and a definition that really feels tangible to advisors and clients.
Yeah, Cash, if you actually go back now really 25 years to when we launched our disability benefit, it was quite a bold move. At the time, there were only occupational type disability benefits. You know, defining disabilities according to objective criteria wasn't ubiquitous in the market at the time. And we went with quite a bold approach where we said we're going to completely make this objective. And you know, those different occupational definitions, same or similar, nominated, own. It created a lot of subjectivity. There were a lot of complaints at the Ombudsman. It was very difficult from a claims assessment perspective. And we actually, up front, we went in without a Cat D. We actually kind of tried to go so wide and so deep in our objective criteria under disability that we went to the market and said we're so confident that we don't even need occupational criteria in terms of how we assess our disability. There was some pushback over the first couple of years, and we actually ended up adding Cat D for free to kind of show the confidence in the breadth of those medical criteria. And you know, so I think it's because of that evolution that we've had to, up front, we had to design very broad medical criteria on our disability product, and it is by far the broadest that's available in the market today. And you can see 77% of the claims last year were being caught by those objective medical criteria. So they're working really well as part of that kind of claims funnel or filter.
Sylvia, you see these claims on the daily. Talk us through some of the headliners. Seems to be cancer across every benefit.
Always, sadly. But I mean, you'll see from this little chart, our top 4 conditions that we pay for under capital disabilities: your cancer, nervous system, musculoskeletal, and mental and behavioural conditions. Cancer is almost always paid at a category A. It's a definitive sort of diagnosis, relatively easy to assess, and I sometimes wish we'd have more definitive conditions. But you'll see through nervous system and even musculoskeletal, there are still some claims paid at category A and B using our medical criteria. And that's when you've got the paraplegia, the sort of neurological deficits where it's cut and dried. But then you've got category Cs. And if you have a look at the musculoskeletal and the mental and behavioral conditions, that's where you start seeing that little black block with Cat Cs being paid. Because often you've got a chronic back problem, a depression, you don't know whether it's going to be permanent or not. And really what we start doing is paying these Cat Cs, and at the same time sort of have a look at the sort of occupational assessment to establish permanence. And as you can see, eventually that does lead to occupational disability in those kind of categories. But quite a powerful benefit, just given all of those filters, because we try and touch each one of them to ensure that we try and pay a claim.
And then building in the F&A process into product design, which I think is one of the things we do really, really well, and the outcomes for clients are exceptional. Gareth, the first thing being that the gap aside of the numbers on the screen, there's a significant gap in the market for disability cover, but a Category B payout on a lifetime benefit being paid at 100% is again not something commonplace.
Yeah, I think that's quite unique in the market, and really the thinking there is for clients who are, they might have a debt or they might have, outstanding obligations from a financial perspective, and whether you're partial permanent or permanent, you probably still want to pay your full debt off. And that allows that kind of planning to take place. So take the lifetime benefit and it boosts all your Bs to 100%. Those clients can kind of eradicate their financial commitments regardless of whether it's a Cat A or Cat B, a partial permanent or a permanent condition.
And we still see clients without the feature on their policies, and the gap is apparent, Gareth.
Yeah, absolutely. And I mean, it would have been an extra 2 million per client if they had actually had lifetime. This is another great opportunity. The take-up is definitely not as high as we see on the lifetime severe illness, but we're starting to see it play out strongly at claim stage, and something that I'd urge you all to look at your disability books, and we can identify where your clients could qualify for that kind of upgrade to lifetime disability. We're seeing it play out very powerfully.
Yeah, and alongside the boost, which I think is the most crucial feature of a disability product, enabling that full payment of sum assured, are the ability of a product, a financial product, to afford a client their pre-disability quality of life. And we do that through the MedTech booster benefit. Sylvia, the claims example, I think, is probably the best description of how this benefit plays out for clients.
Yeah, no, for sure. So, I mean, we have a young person, age 35, and he was involved in a motor vehicle accident and ended up losing the sort of loss of use of his hand. Dr. Dedra will tell us, so she knows this case. He had three fingers amputated.
4 partial or full amputations of his fingers, of his left hand, which led to a severity B claim.
Yeah.
So again, with him, he had the lifetime, and he was boosted to 100% for his claim already at the time of the diagnosis. He fortunately also qualified for a Group 2 MedTech booster claim, and that afforded him another 460,000 rand of payout at the time of the diagnosis. Now, Melusi could have taken that money and spend it towards a prosthesis for his hand, where he would end up being far easier to rehabilitate, and he could re-enter work situation far easier with a functional left hand. The good part is that this is not the end of it. Over the next 15 years, he will receive another 460 rand in payout in the MedTech claim, and that he can use towards maybe servicing the prosthesis that he had, or as technology advances, maybe upgrade the prosthesis that he's got. So we are really taking care of him after this dreadful accident that he had, almost for the next 15 years, to help him to return to a functional status in his work environment.
Yeah, no, for sure. I mean, and if you have a look at the claims that we've paid, 17% of our claims were for disabilities that qualified for MedTech Booster. And that really allows the client to have these sort of financial means to regain their independence and quality of life to a certain extent. And I mean, of the MedTech booster payments we made in 2025, it boosted their average capital disability by an average of 25%. And I mean, that's quite remarkable, especially given that it's a Category B claim, where in many respects he would only receive 50%. But with lifetime, he gets 100% right up front.
Yeah. Now, and I think disability cover is incredibly relevant, and we've spoken about it in the context of returning to work and regaining independence and ability to function again in society. But then there's the other element where we realize it doesn't come to an end necessarily, Gareth. The category A and B criteria, almost the medically objective criteria, still plays a place or holds a place post-retirement.
Yeah, Cash, and this is such a powerful kind of hidden feature in the disability benefit, where at expiry it just converts seamlessly into the severe illness benefit. And you know, we need severe illness at any time, but particularly as we get older, those severe illness claims really do start to happen. And we've paid 164 million last year under that converted SIB alone. You know, that's 10% of our total SIB payout was under that little converted SIB feature. And most of those clients didn't even have other SIB. So it was as a result of their disability converting that they were able to access that payout. So keep that converted SIB in force. It's a very valuable feature that kind of sits where those clients are almost pre-underwritten through their disability to have access to that whole of life SIB into retirement. Very powerful.
And then I guess coming to, I know we're running towards the end of the presentation, so I hope you can be patient with us just for another 20 minutes. But the cornerstone for me of financial planning is our income continuation benefit. It allows a client to still retain the value of their income and plan for everything else that income affords them. So whilst the benefits like your severe illness and your disability and those lump sum features create that immediate cash flow injection into a household when that financial sort of burden appears, your income continuation benefit assures that your income doesn't stop at any point. And from a claims perspective, again, I guess cancer coming in, but for not headlining here. This is always topical.
This is unique.
This is unique in that musculoskeletal claims usually are the main claim cause under our income continuation benefit for both males and females. Dr. D?
Yeah. Yes, so we do see musculoskeletal benefits being very relevant. Musculoskeletal claims being very relevant for both males and females. They amounted, 30 and 40%, so we're approaching half of our claims that we see for income continuation benefit for these benefits. And I think it's important to understand that these are things that could happen to anybody. You know, you could have a fall, you can trip at your home and be in a car accident. This is not somebody that is necessarily sick and now developed sort of a deterioration of a chronic condition or so. So these are really benefits that is accessed on a daily basis by healthy people where something went wrong. So I think that is the very powerful message for the income continuation benefit. This is really the benefit for our healthy people. Most of these claims are temporary only, and that is where we financially support somebody where they need to recuperate at home, maybe can't work immediately, and we pay that amount for them while they need some time off to get better.
And you touched on something interesting, that most of the claims are temporary, but what we actually see in terms of the value of the claims, Gareth, is the opposite. That the value of the claim is more, leans towards the permanency of the benefit.
Dr. D is right in that, from a count perspective, obviously most are temporary. I still find it fascinating how many are permanent. So in that left-hand graph, you can see kind of by age group of all the clients we paid last year, was that claim a temporary or a permanent claim? And I find that remarkable. Of it, let's pick an age group. If you pick the 31 to 40-year-old, you're sitting at almost 30% of those claims are permanent. Young people, 30% of the claims are actually permanent. They can't work ever again. Okay, so while it is the minority, even in terms of count, I think it's quite staggering how many claims actually tend to be permanent. And then when you flip that into value, 73% of every rand we paid last year under ICB was to a permanently disabled client. And that's because once you're permanent, you're always in that pool. You're getting paid every month, you get the upgrade, temporary clients come on and off the payment list. So from a value perspective, most of the value in ICB is actually sitting in the permanent component. And that gives you a clue as to what to consider as part of your financial planning. When you're looking at different products in the market, it's not necessarily about what's the easiest to get a 7-day waiting period claim for a couple of days. It should be about where is my value from a permanent disability perspective sitting, because that's actually where the cost sits in the income protection product. And that is exactly where our product is so powerful. The fact that we've got this inbuilt whole of life protection, it means that a client, let's pick any age, whole of life is not just about having that cover post-retirement. It's valuable today. A 60-year-old who becomes disabled with us gets paid for whole of life, compared to stopping that payment in the next 5 years at a competitor. So from a PV perspective, that's 234% higher present value of payments. And you can see these numbers across the board, even at younger claims. A 40-year-old today, many of them are permanent, we just showed that. And they'll be getting 40% more value with us than a traditional non-whole of life product in the market. So you can see exactly where you should be thinking from a value perspective is where we are so differentiated against everything else that exists in the market today. Multiple times so in many cases. So many people, it's a bit grudge in that ICB tends to be quite an expensive product. And so often you've kind of paid for it your whole life and you end up getting the claim at 63, 64, and then it stops. In this case, that continues for whole of life. So it really, really is a powerful kind of embedded feature of all of our income protection.
And other embedded features are your features like your family protector, which plays out every year. Without fail, we see a number of claims under this feature. Your contribution protector, I guess, probably one of the most spoken about features of the income continuation benefit. Sylvia, Gareth, what have we seen in the most recent year?
Yeah, so but as Cash says, with ICB, it's not only about your own personal income. It covers your whole family. And I can probably talk firsthand about a friend of mine that was severely ill last year, ended up passing away. Her husband had ICB and with Family Protector, and he was paid. So, 2.5 million rand was paid under these Family Protector benefits overall. And that's a significant amount of money when you actually don't expect it, but it's when you need it. I know, with him in particular, he literally spent 3 months at her bedside in hospital. And he's a lawyer. And business kept on running, but he was able to actually spend the time with her before she passed away. So that just brought home for me how powerful these Family Protector benefits are. And then you look at maternity waivers. We waived 130 clients' premiums while they were on maternity leave, and they were fully covered while they were looking after their baby on maternity leave. And then, if you look at our contribution protector, that for me is just the most powerful component of ICB. We paid over 21.3 million rand in claims last year on ICBs. And that when you're paying a claim, that largely represents close on 16% of additional income that the client is going to be getting. And if you take it right through to Dennis's experience, he received the ICB payment, and he was substantially insured for 266,000, and he was able to get up to 33% of his Discovery Life premiums back. Well, not only Discovery Life, it included Invest and Health and Vitality and Insure. I haven't missed anything out, have I? So he actually was paid an additional 84,000 rand close
This
to
is not a nice
85,000.
to
Yeah.
have, Gareth. It's not a nice to
Yeah,
have.
people
It's
call this a
actually-
bell and whistle.
It really isn't.
This is massive. That's 85,000 Rand in discovery contributions that are being covered on top of getting paid his full income.
So that
Yeah.
your car insurance can continue, so that your vitality
Exactly.
periods
It's
can
just
continue.
it's a massive amount, and many of you in this room sell the full suite of products. So you'll have, your clients in this boat where when they become temporarily disabled, they get their income protection, but also their full suite of discovery products. And lots will be at that cap at 33%. We know how much one can pay to discovery across the board of these benefits, and that is just such a powerful embedded feature in our ICB.
And then I guess last but definitely not least, education protection, which is all encompassing, and it covers some disability, it covers some severe illness, and it covers death of a parent, so that we can ensure that whilst something like that might happen, the future aspirations of that family and the lineage can continue. The map was fascinating for me this time, Gareth. We're starting to pay across the globe, which I think is always brilliant to see in action. Currently, we're protecting the education of about nearly 32,000 children, and 605 are receiving payments through the benefit already.
Yeah, no, this really is gratifying to see every year, Cash, and these numbers are significant. 605 kids who we're putting through education. Something's happened to one of their parents, and their full education journey is indemnified through the product. It's amazing to see the university funder benefit payments start. For many years this was kind of a concept, one we were really proud of. I spoke about it earlier, but kind of turns parents' engagement in health and wellness into funding their kids' university education. And you can see we already are funding 139 kids' university education through that university funder benefit. And that will start to increase exponentially as more and more clients reach those ages. So a very, very powerful benefit. It's so difficult to do this through traditional means. You're just guessing how much cover that client's going to need in terms of education. Education inflation changes each year. It's much higher than normal inflation. As your kid gets older, obviously the cost of education increases exponentially. So to try and work all of that out and hope that the lump sum you take is enough is really putting the risk back on the client. Whereas here, we take the risk. We closely follow exactly how much to cover so that we can indemnify that full education journey. And that kind of allows clients to sleep easy at night.
No, absolutely. And we've seen some claims on both fronts. So a claim in the form of a university funder benefit, so the great shared value that comes out of the benefit, but we've also seen a claim through through death, which is on the dollar global education protect. I mean, we haven't spoken too much around dollar, and we see quite a number of claims throughout, but I think this spotlights the power of having a global benefit. Silke.
Yeah, so, Cash, this particular client obviously had the dollar plan, died in a car accident at the age of 42, very young, and had one child. The child was about 4 years old when the father passed away. But with the global education, we were able to pay immediately, starting with nursery school level as well. And so if you look at it, this child going right through to university can be, we're expecting to pay over 15.1 million Rand. Plus, and translated into dollars, it's 784,000 Rand. That's staggering. And that just shows you how important it is to have such a powerful benefit.
Yeah.
And
remember on that dollar version of Global Ed, yes, it is a little more expensive, but that covers international level schooling.
True.
And what's unique about it is it will always pay out at the cap offshore, regardless of where your child goes to school. So it doesn't mean that if your child ends up going to school locally, that you're kind of losing that money. It will always pay at the international level schooling rate. So in many cases where the child goes to school locally, there's a really nice offshore pot of money building up, possibly for that child, when they, kind of graduate or whenever it might be. It's a very powerful benefit. The actual size of that cover is enormous. This client actually also had life cover of 10.2 million, which sounds like a decent amount of life cover, but the global education, in international terms, would have taken up 90% of that 10.1 million itself.
Yeah.
So it kind of shows the actual value sitting in that dollar version of global ed.
And then that's a sad note, but to end on a happier note on the university funder benefit and monetizing some of that healthy behavior that parents partake in, we have the Smith family experience. Sylvia?
Yeah, so, this just also brings home how powerful it is to being engaged. So, this client had the global education with the university funder benefit, and in 2025, the daughter started studying towards her degree and was able to capitalize on his university funder benefit. And that paid out 39,000 Rand, which is not a lot, but it really did help towards paying those university fees.
It's not a lot, but interestingly, it's more than the entire value of the global ed premiums that client paid.
Yeah.
Yeah.
So you can see how much value you get back through that university funder benefit in kind of relative terms.
And on that note, I think we've covered all of our benefits in quite some depth, but we always need to leave you with some support around our benefits and around the claims that we've spoken about. Of course, I can't leave today's session without emphasizing that we do have an Advisor Insights dashboard, which provides you with all the opportunities. And opportunity is a word that we use in a sales context, but really these are clients who need the cover. Clients who should have this cover. We've identified children who are unprotected by a child protector benefit, children whose aspirations are not protected by a global education protector. We've identified people who are not protected for the best of breed cancer cover. These are, we call it, and like I said, opportunity for me feels a bit of it doesn't feel like the right word in today's context, but it really is an opportunity for you to go out and ensure that these clients are adequately covered for what they actually need. We also have some limited offers, Gareth.
Yeah, Cash, hopefully you guys saw we rolled out a dollar offer over the last couple of weeks or so that will be available. We managed to secure 12 Rand 90 to the dollar, which in the context of kind of what's happened globally and the economic volatility and uncertainty that is playing out across the world from a geopolitical perspective at the moment. 12.90 is a pretty good rate. You've got that available over the next 3 months until the end of June. So make sure that your clients have that foot in the door, have that dollar policy locked in at 12 Rand 90, and can diversify their needs from that perspective. And obviously, the existing 25% enhanced integration discount is also continuing to run until the end of the financial year. So a couple of opportunities from a special offer perspective.
And then lastly, the content that's developed usually around the Claims Roadshow and all these insights that you have seen today will be available in the form of a digital document. We have the one-pages with profiled claims experience for specific segments of our client base. We've got client testimonials, both written and on video. And then we've got the updated Discovery Life Claims website, which I hope everyone has bookmarked. I know I don't go anywhere without that bookmark. It lends for very interesting conversation for those who haven't opted to be covered by life cover. Thank you so much for attending today and spending this time with us. We really do value your time.